Hi traders, welcome to the Ken Tank, where you'll learn how to avoid getting eaten by the sharks on Wall Street. It's always all information for educational use only. I'm not making advice about what to buy, sell, or hold. Hello active traders, and welcome to another episode of the Ken Tank. In this episode we're going to be looking at how to use position sizing or scaling to add to your winning trades. It's one of the most important professional trading tips you'll ever learn, because what it does is help you build equity or build a winning trade by leveraging into it with minimal upfront risk on the front end. It's much smarter to play a handful of different stocks and then feed the winners, is Wall Street talk. You feed the winners and starve the losers. Add to your winning trades as they go up and scale out of the ones that go sideways or down. So let's take a look first at swing trading charts. I've got several here for you. Then I've got a couple of day trading charts I think you'll really like. So first let's take a look at these charts. I want you to start off by looking at how much profit potential exists in the chart using your current trading strategy. If you could go back in time and start an initial trade, let's say you bought the first breakout somewhere back here, say at $28 a share, and let's say you traded just 100 shares, that's up 8 points, which would be $800. But if you had added to it, say up over 31, so you did 100 shares here, then another 100 shares here, you would have close to doubled your profit because you scaled in over time. Now, I like to keep things simple and easy to understand. So as we go through these charts, I want you to think about where would you set your initial entry if you could go back in time and trade these charts. Where would your first entry be, and where would your second entry be? Personally, in my own real money trades, I like to wait until it's gone up a couple 3 points. But the main first point is I want you to start looking to add to all of your winning trades as a rule of thumb. That's what always the professional Wall Street traders do. We always use position or sizing or scaling or laddering in or layering into a trade, whatever you want to call it. The reason that you want to do that is because otherwise the only alternative is to put on a large trade on the front end to make the money, and you get stopped out a lot and take a lot of expensive stops. It's a potentially much safer way to play a field of say 3, 4, 5 stocks that are starting to go up. Plant small seeds, do small trades, 50, 100, 200 shares initially, and then add to them once they grow, instead of doing this 1,000 share pop and drop penny stock video game type trading, which does not work for the majority of traders. You want to use a steady uptrending chart that you scale into to build a trade. So CFG, what's the characteristics of successful scale in trade charts? The first is it works best with steady uptrends. So if it's a chop zigzag chart like the penny stocks, those are really stupid to use because they will stop you out, obviously. You want things that have a history of institutional and retail buying pressure that continues on up day after day, week after week, like the CFG chart. Let's take a look at another one. Here's PGR. Now you know that I'm an advocate of buying. If you followed me for any length of time at Money Show Traders Expos or at the Money Shows or my Stocks and Commodities or Active Trader Equities articles, you know that I like cut breakouts outside of a false breakout window. And we like to set a breakout trigger that gets us in on the first major run of the stock and avoids the choppy pullback and so forth. Anyway, let's say you got in somewhere in this region. You got long here, 100 shares at 33. Where would you add? I'll give you a second. Let's say you could roll back the sands of time, and here you are. You got your initial trade off here. Where would you add to it on the way up? You can always use a piece of paper and kind of simulate the passage of time. Where would you add to it? I think one of the challenges that a lot of traders I've worked with is that they use choppy charts and they overtrade too soon. So that brings me to my second rule, is wait till your unrealized P&L is up, so you're playing with the house's money. I like to wait till it's at least up $300, $400, $500 in the trade, or 2 points, whichever gets there first. So 2 points or so for these stocks in the $20 to $40 or $50 share range makes sense, right? So if you bought somewhere near 33, the next buy-in would be up, say, somewhere north of 35. And at what point, I always get this question, where do you try your stop? Where do you set your stop? The initial stop is no more than, say, 2 points under the current entry. Once you get, I use 2 points a lot for these stocks because it's a good rule of thumb type entry. Once you put on your second, this is a rider downer, it's important. Once you add to a winning trade, let's say you did 100 shares somewhere in here and you bought another 100 up there, question mark, where do you trail a stop? What's the right answer? The right answer is once you're starting to leverage up, you must use a break-even exit. So whatever would get you out at flat is the initial breakout. Now that doesn't work, say with penny stocks or cheap stocks, because those guys zigzag up and down like a yo-yo or ping pong ball, and they're no good. That's why professional traders, we always stay away from the cheap under $10 penny pop and drop risky amateur stocks. And despite people out there claiming to be able to live on tropical islands and all that kind of lifestyle nonsense, those of us who are real traders know that that's just a bunch of hogwash and BS and fantasy. The truth of the matter is you've got to make it up in your P&Ls by trading strong trending instruments that are likely to go up for at least a few weeks in a row. Okay, and you're not going to get that in a $3 stock for the most part. You may find a rare unicorn exception out there, but for the most part, your very strongest charts are those that have sustainable multi-week, multi-month trends above all three 50, 100, and 200 simple moving average lines, good institutional type trade setups. Now another question may arise, and that would be, at what point do I stop adding to winning trades? If you're new to doing this, say your first 5 or 8 years of experience, I would only look to add once. Okay, because that's a big learning curve. You got to take time figuring this stuff out. So keep it simple as a rule of thumb. Don't look to get all exotic and, well, let me add reverse martingale style and do 100 there, 100 there, 200 up there, another 400 up there, and it's complicated and challenging to make work. Keep it simple. Put on your first trade, add to your second trade once it's gone in your favor by at least a couple points, or at least you got a few $100s to play with of unrealized P&L because you made a winning initial trade. And from at least what I found in my own trades is the position sizing or scaling in. And for more on position sizing, learn from my colleague Dr. Van K. Tharp. He's the expert in position sizing. I'm also an experienced trader in using that in my real money trades. And one of the things that I found is keep it simple, use strong trending charts, look to add to all your winners, and make sure that you're using this in conjunction with steady uptrends. When I first heard about position sizing, I thought, hey, it's a holy grail. That's it. That's the answer. What I found subsequently in years after that is, that's great if the chart, in theory, position sizing is great if you got a continuous uptrend chart. You could throw darts at it all day long and come out smelling like a rose. The problem is, in the real world, we got these things called pullbacks or downright trend reversals, right? Or chop and drop, or something will gap, and then what do you do, question mark, with that trade? Or let's say gaps above what you would looked at as your secondary entry trigger. How do you figure all that stuff out? I answer that question and more in my Momentum Doubler DVD course. This came out a few years ago. It's been really popular. I'll likely turn it into a downloadable video course, so if you're watching this YouTube video in years to come, you may not see this, or you may see the fact that it's downloadable. For now, it's a physical region-free DVD course. It's shipped from Amazon's CreateSpace. But anyway, you may want to look at the video at momentumdoubler.com. This features real money trade examples I did. So I walk you through some real money trades and setups for what I did in my own actual trades and how it worked out and the lessons learned and all the rest of it. So anyway, that's a resource for you. But back to our regularly scheduled program here. Look to scale in on trades that have reasonably strong charts. And if you do trade cheap charts, like this one, HOV, make sure that they have a trend like this. If you do trade the cheaper charts, make sure that they have a sustainable uptrend. Okay, now it's starting to drop. Here we got almost a hammer here, bullish reversal. But overall, it's stopped its momentum run up. But it ran all the way from 1.5 to just under 3, so it nearly doubled. So if you do look to trade cheaper instruments, make sure they have a continuous trend like this. One of my favorite patterns is what I call an acceleration ramp, and that's where you've got a steady uptrend followed by a sharper angle breakout, which often accompanies either a gap or a tall green candle that then runs up afterwards. So if you look to, let's say you got an initial trade off at a point, $1.80 or something, the next trade I would do, at least in my own strategy, would be up at say 230. And I'd likely have gotten out up here during its pullback. So trade 1, trade 2, in once, in 2, and you're out. But often, most of the charts down that are this cheap don't give you this nicely well-mannered, strong trend strength to work with. Most of the cheap charts are zigzag up and down. Okay. Let's take a look at a couple of day trading chart examples. Here's one. The gold miners have been strong lately, and if I pull this over so you could see, Newmont, say on Thursday on the way up or Friday on the way down. Either would have been good for scaling. I like to buy roughly 30 cents above the open range breakout high to get in on the first trade, and I'll often scale in 40 or 50 cents above the high for a secondary trade, and then get out at the first sign of a reversal, wherever that may be occur in the morning. So that's a good chart. One from yesterday that's good is this GBX ticker, or I should say from Friday. I'm recording this on Sunday, the January 8th. But anyway, 2017 already. If you get in on the first one, maybe you get stopped out. Okay, well, you get in again. Hey, it's in the money. It's starting to run. You scale in again somewhere during this multi-point run, and then get out somewhere here during the pullback. Trade one, trade two, and you're out. It'll help you if you start looking at the charts and figure out a set of rules for price action for scaling. What would be a sensible place to scale in, and where would you add to a winning trade? And see how good you would get at it, at least on paper, as you start to learn this very important professional trader's technique. And again, this generally is not something you want to use with cheap charts. You know, there's some of these moron pop and drop penny stocks like CNAT. Oh, I'll buy, oop, I get stopped out. I'll buy, ooh, it's starting to work out. I'll buy again, oops, I get stopped out. Okay, I'll buy again on the bounce, so I get stopped out again. You know, don't trade charts that have no history, kind of like bad people with bad backgrounds that fail a background check. Like this VBIO chart. I'll get in here, I'll get in again. Oops, I take a huge stop. Oh, it's starting to bounce, I'll get in again. Oh, I get stopped out again. The problem with the penny stocks or the cheap stocks is you hear about the 0.001% of the winners, and you don't hear about the 99% of the people who lose their butts trading penny and cheap stocks. It's kind of like a lottery effect. You'll hear about the 2 or 3 winners. They'll say, hey, I made all this money. What you don't hear about is other 99% that lose their shirts, because it's kind of like going into a Wall Street, going into like the equivalent of a Wall Street casino in Las Vegas and putting all your money down on 18 red or something on a roulette wheel. Yeah, the leverage is great if you happen to beat the odds, but for the other 99% or 94% of the time, you're going to lose your money. So, or charts like this one, KOOL, is another perfectly horrible chart that nobody in their right mind should be trading. Oh, I got in. Oh, I got stopped out. I got in again. I got stopped out again. Derp. Just say no to cheap penny stocks. Those are horrible. What you want are charts that, yeah, they cost a little more coming out of the gate, but it's much smarter, I think, to trade even just 100 shares of a $3 stock with a strong trend than 1,000 shares for the same capital outlay of a $3 stock with a horrible trend. Because where you make it as a trader, and you have my word on this, it's very, very important. Your number one goal as a trader should be to use very tight stops when you're wrong. Number one rule for position sizing or scaling is you really want to seek out an opportunity to build winning trades, kind of like snowball, like those cartoons where you see a snowball rolling downhill and it gets bigger and bigger and bigger until the time it gets at the bottom. As a trader, you want your account to get bigger and bigger as you add to your winning breakouts as they're in motion, and you only get that with these sustainable, good trending charts. So to recap, look to add to all your winners as a foundational approach to professional trading. It's something, your first trade should not be the end-all be-all, like you're going to Vegas and pulling a slot machine handle. That's what gamblers do, and we're not gamblers. If you want to potentially extract money out of the market, you have to build winning trades patiently. Or day trades, maybe you're waiting 5 to 8 minutes to add, but swing trades, it may be a week or two before you add to a winning trade. That's okay. Your fundamental goal as a trader is to extract as much money out of the chart as you can. And if you dump it all in and do, say, like 1,000 share trade on the front end, you get stopped out, and then it runs without you. I've been there, done that, got the t-shirt. It's really frustrating. Instead, what I found was you do a small share trade. Maybe you get stopped out. You take another shot at it up at new highs. Okay, that's working out. Now you add to it. Okay, you're in the money and you're in the clear, and you finally made a successful trade setup. There's very few things are more frustrating than being directionally correct. Like, it's going up, I'll buy it. But then trade-wise, you get stopped out on a pullback. And then it runs without you, just to rub salt in the wound and make you get frustrated. So one of the safety nets to professional trading is start off really small. I like to start off 100 shares or less in most of my positions nowadays, but I may trade more instruments, maybe 5 or 8 or 10 instruments, different stocks or ETFs or whatever I'm trading. And then I will add to that subset of that group, say out of 10 trades, maybe 3 start to run up after a week or two. Okay, well then I'll start to feed those and build the trades and take tight stops on the remainder. It's only by adding to your winning trades that you can potentially overcome the cost of stop losses when you're wrong. And that's why professional traders rely upon this as such an important trading strategy. So anyway, I've run over on this about 15 minutes. I like to try and keep these to 8 to 10 minutes, but it's really important that you look at that. So look to add to all your winners. Wait till your unrealized P&L is up. I like to wait till at least a few $100, $200-300 up before I scale in or add to the trade. Works best with steady uptrends. Works worst with cheap sub $10 penny pop and drop risky amateur stocks, as do most professional trading approaches. Don't work well with the cheap charts. So just say no to charts like this. Hey, it looks really good. Hey, if only I could go back in time and trade 10,000 shares and sell the top, I would have made a fortune. Yeah, but the rest of the time we don't have the answer key. You know, you may buy up here and then scale in and then take a big stop loss, buy on a bounce, get stopped out again. That's why these kind of charts are especially hazardous and risky and stupid. And instead we want charts like this, or if you do trade cheap charts, something like this, where there's some semblance of a steady uptrend that can actually do well for you in your trade. So anyway, with that, I'm out. Until our next episode, I wanted to wish you the best. Trade with passion, trade with tiny stops, trade to scale into your winners and make it work. I'm Ken Calhoun, TradeMastery.com, wishing you the best for a successful trading year ahead. Goodbye, everybody. Be sure to join my subscribers at swingscans.com and tradingtheopen.com so you can see these types of alerts in each week's markets.